Okay, since a financial ratio is just the division between two numbers, right? Then now it's pretty simple. Then we already in the previous video we mentioned the basic financial statement variables. Then what we will do is we're gonna start talking about the relationship among them, and later on about a specific financial ratio and what do they mean, right? Then the first relationship that you should know, okay, all the accountants, all the business people should know this, is that total assets is equal to total liabilities plus shareholder equity. Okay, we already talked about this in the video where we talk about introduction of financial of balance sheet. Okay, then what the total resources of a company come from either what the company owns and what the company owes. Okay, then that is the first one. Okay, now the other one is shareholder equity. Okay, shareholders are people who have a share in the company, who hold shares in the company. Okay, who own the company. Okay, then shareholder equity basically this is defined as common stock plus retained earnings. Okay, common stock is the initial amount the investors contributed, and retained earnings, accumulated return earnings, is the wealth that is generated by the company due to the specific activities, business activities of the company, specifically the net income, right? Then is how the company start making net income, then that is accumulated in retained earnings, and then it is part of the wealth of the investors, right? Then every term, every period, the retained earnings or the net income is added to the common stock. Then if the company is doing okay, then the shareholders will be very happy, right, that their investment is growing through the wealth generation process of the company. Okay, then what other relationship we have? Total liabilities is equal to what? To current liabilities plus long-term debt. Then total liabilities is the short-term debt, we can say, and the long-term debt is how much the company owes to could be suppliers. Usually here are suppliers and financial institutions. Usually here are banks or financial institutions. Okay, what other formula is we can start putting formulas together, applying just simple algebra, right? Starting from this one, total asset is equal to total liability, and total liability we can say that we can talk about the specific components of total assets. Okay, then total assets are basically are composed of cash, right? It's a more liquid asset, plus accounts receivables. So account receivables are the specific amount of money that the customers of the company owes to the company. Okay, and plus inventory, right, is the value of the inventory, the book value of the inventory of all the products that have not been sold yet. Okay, then plus the gross plant and equipment, right? This is part of the fixed assets. Okay, and plus depreciation. Okay, remember that depreciation is usually negative, yeah, right? I'm gonna put plus here, but usually this amount is negative. Okay, usually. Okay, always. Then current assets. Well, then current asset is a piece of this one is cash, right? Cash plus accounts receivables plus inventory. Okay. And what else? Total liability. We can say it's accounts payable. This is the short-term debt we have with our suppliers, right? When we buy raw material, some suppliers have credit with us, or we have credit with them. Then we can pay them later on, and we can receive the raw material earlier. Okay, this is the amounts payable that usually we have to pay it maybe 1 to 3 months from now. Okay, then what else? Plus current liability. Okay, plus long-term debt, right? The current liabilities are all the liabilities could be short-term debt that the company owes to could be any creditor. Okay, then now let's go to do simple math, right? But just reviewing what is EBIT, right? EBIT. Okay, then EBIT is earnings before interest and taxes. Is basically which are earnings. In this case, is just sales minus cost of goods sold. Okay, is basically cost of goods sold is the cost of the variable cost of production. Okay, and you gotta subtract also the sales and general administrative expenses. Okay, if you're a production company, then you have the amount of revenue, the sales. Okay, you gotta subtract the cost of the raw material, the cost of labor, everything that is related to production, right? That is a variable cost, and also you gotta subtract all the fixed costs that are related to basically general administrative expenses. Okay, then this is earnings before interest and taxes. Okay, then one might be earnings before taxes, then is basically earnings before interest and taxes minus interest expenses. Okay, then the interest expenses are the expenses that are due to specific debts, okay, that the company has with financial institutions. Okay, then what else we have here? Then we can go down and we can say and the net income, right? The net income, right, is equal our earnings before taxes minus taxes. Okay, so after you pay taxes, then you get the net income, right? That is one of the most important measures for business people, for the managers, for the executives, and specifically for the CEO, the Chief Information Officer, and also a very important measure for the investors, the shareholders of the company. Okay, they are always interested in looking at the net income of a company. Okay, then now I'm gonna stop here. In the next video, we're gonna start doing some very basic math, dividing only variables against another variable. Then we will start computing financial ratios. Okay, then see you next video.